Hello and welcome to Market Domination. I'm Julie Hyman. Josh Lipton is back live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
From today's top investing stories to Yahoo Finance's trending tickers to the macroeconomic forces shaping markets, we dig deeper into everything you need to know for that last hour of trading.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I think at some point soon we have to pull back, and that will be normal. That will be healthy. But I do think it's going to be something that's going to last more than just a couple of days and just a few percent.
This particular bill ensures that ByteDance divests itself of the vast majority of the ownership of TikTok. Our intention is for TikTok to continue to operate, but not under the control of the Chinese Communist Party.
2/3 being in the affirmative, the rules are suspended, the bill is passed, and without the objection, the motion to reconsider is laid on the table.
What we've told investors out there is, if you were going to kind of play this event, the best way to play it actually is with Snap.
Certainly, if it was shut down, the place you're going to go is probably on YouTube, and the advertisers would flip over. So Google could be a beneficiary. Obviously, Meta and Pinterest also could see more time spent.
We've got 1 hour to go until the market close. So let's show you where we are in the markets and how we got here. Let's take a look at the major indexes. First of all, the Dow coming down from the highs of the session. At one point today, it was set to close at a new record, but it's not there right now as we see that roll over a little bit, still up about 1/5 of 1%. But the other major averages are lagging today. We've got the S&P little changed, although it has been bouncing a little bit between gains and losses. And the Nasdaq, the laggard, off by about 1/4 of 1% today. A little bit of a drifting kind of day here without a big economic report like CPI, for example, to push things. But we do have the XLK, which is the tech ETF, down the most today, off about 0.9 of 1%. Real estate as well. And then on the plus side, we've got a rally in commodities that's been going on. So XLE energy up the most today, along with XLB, which is materials. So that's been an interesting story to watch here as we see some rotation happening in stocks. Josh, let's talk about the big other story we're watching today.
For sure, Julie. The House has indeed voted, and TikTok could be on the chopping block. Today, representatives voted 352 to 65 in favor of a bill that will cause ByteDance, the Chinese owner of TikTok, to either divest the company, selling it to a U.S. company in the next 6 months, or face an entire ban. It now heads to the Senate. Rick Newman has been following this. So that's it, Rick. Attention now goes to the Senate. What do we think is going to happen there?
They're going to slow roll it. I mean, so this kind of came out of nowhere that the House passed this, but it's not going to happen that fast in the Senate. The analysis I say, the forecasting I'm is 40% chance the Senate passes this year, let's say. And then let's say that this Senate does pass it, and actually President Biden has said he would sign it. A lot of the headlines focus on this law that would ban ByteDance and ban TikTok. Well, that's not the main purpose. The main purpose is to leave TikTok intact and just force them to sell it to somebody else. TikTok is going to be here for a good while. So even if this passes, even if President Biden signs it, it seems almost certain that ByteDance, the parent company, would challenge it in court. That could take years. And who knows when this whole thing might get resolved. And then there's the chance that the Senate does not pass it this year, and we have to start over again in 2025.
Well, and isn't it sort of effectively a ban, because some are saying, ByteDance has said it's not going to sell it. So if it's not, then...
I mean, do you believe that? So
I don't know what I believe.
So follow the possible course of events here. First, fairly low probability that Congress as a whole passes this law this year and then President Biden signs it, okay? If he does, if that actually happens, they're going to challenge it in court. How long is that going to take? 3 years? 4 years, 5 years? I mean, is it going to be Microsoft antitrust legislation all over again? I don't know, was that 10 years? Yeah. So this is going to go on for a while. And I mean, in the meanwhile, the TikTok app will continue to operate. Let's say it actually came to, it all gets through court, and yes, this is going to happen. You either have to divest or the app is banned. Why would they leave money on the table and say, well, we're just going to shut it down And I mean, could they even do that? I mean, you know, this is a normal private sector company, you know, in some ways. Like, you don't just shut down a valuable asset that you could sell for a lot of money and say, we're just angry, so we're just going to shut it down. So, you know, sometimes a divestiture can actually be good for shareholders. It doesn't mean they're going to lose money. They could make money.
What do you think politically, Greg? I should get your take on Trump's role in all this, because he's been out there saying, well, yes, it might be a national security threat, but if you ban it, he says, you're going to just make Meta stronger. And we know how he feels about Meta and Mr. Zuckerberg. But it is interesting because it seems to be a change in position from when he was president.
It's a complete 180 by Trump. So remember, he actually tried to ban TikTok by executive order when he was president, and nobody was surprised that the courts didn't uphold that. And by the way, there's a ban that Montana passed a ban that courts have also reversed. It can't do. I mean, that's not going to, you know, you just can't do that unilaterally. I think the more interesting question is, what if it actually works and TikTok ends up banned? I think whatever politician was associated with TikTok getting banned is just dead. I don't think any politician could get reelected again because of what you would do. Not just to all the people who use TikTok, but to all the people who have created businesses around TikTok. I mean, there are a lot of legitimate businesses that use TikTok as their main, that is their main way they reach people, right? So I think for President Biden to say, yes, he would sign this bill, I think he is 100% aware that there would be no negative impact on anybody anytime soon, even if he did sign this bill. And we did hear that Biden favors a ban of TikTok because it would not happen for years. As for Trump, you know, he just flip-flopped on this. I mean, what seems to have happened, and he has not denied, one investor, a billionaire named Jeff Yass, who owns part of TikTok, had an audience with Trump and apparently persuaded him to change his mind and gave him these talking points. Oh, what about the competition? It would benefit. Part of the weirdness is, guess what else is part of the competition? Trump's own social network. So in theory, he owns a social network that would be among these beneficiaries if TikTok were banned. Now, I don't think young TikTokers, I don't think there are very many of them on Truth Social, you know, ranting about the evil libs and the, you know, whatever they rant about on Truth Social. But in theory, he would benefit, but who knows? I mean, maybe he's also been chatting with Elon Musk, maybe, and it's not beyond the realm of possibility that there could be some kind of arrangement between Twitter or X and Trump's network, Truth Social.
Interesting. A lot of different threads to pull on in the coming weeks. Thanks, Rick.
Yep,
appreciate it. Well, let's get back to the markets here because we are seeing a mixed picture today, but we have seen the Magnificent Seven get hit hard as of late. Nvidia, Apple, Meta, and Tesla, they're all trading down today. Should investors be worried about the pullback in tech and broader ramifications of that? For more, we want to welcome in Binky Chadha, Deutsche Bank Chief Global Strategist. Binky, it's great to see you. So we've talked to a lot of investors recently about the broadening of the rally. And yet, with the big cap tech down today, it does seem to be taking stocks down along with them. So how far can that broadening go, and can it happen without big tech?
So, you know, for the rally to broaden, so to speak, what you need basically, in our view, is greater confidence really in the cyclical strength of the U.S. economy. I would say, you know, one of the key reasons why mega cap growth and tech have led, especially on a relative basis, is simply, you know, what we call the cyclical overhang. I mean, for the last year and a half, the macro consensus has really been for, you know, growth to fall off a cliff, for the economy to go into a recession. So there's, you know, very little confidence, I would argue. But I would point out that that does seem to be changing. What you're starting to see is CEO confidence pick up on the economy, and that should get reflected basically in better guidance as we go forward. And the better guidance would, of course, you know, at the same time be associated with upgrades to earnings estimates. So the cyclical overhang is still there. It's still lingering. The S&P at, you know, at the market level, you know, it doesn't look like it's pricing in a recession. It's pricing in growth. There's no doubt about that. But I would argue there's plenty of pockets within where, you know, the market still believes a much more negative outcome, and that would really be in the cyclical parts of the consumer. It would be in the banks, and that's exactly where we belong. Yeah.
And Big Guy, I want to get your take on another subject, which is a source of debate, which is just valuation, Binky, and get your take, how you're thinking about valuation for the market, and also, Binky, whether it really matters for returns in the near to intermediate term.
So what I would say is, first of all, where are valuations? I would characterize valuations at the market level as basically being pretty full. I would argue that, they're not necessarily, extreme or hugely overvalued. What I would keep in mind is basically that, just think about the S&P 500 multiple going back 100 years, and you see that it basically generally remains between 10 and 20. And then you look at the times that we were above 20, which is where we are today, and you will notice that most of the time when we went above 20, outside of the late 1990s, was when we were having a cyclical recovery. So, for example, coming out of a recession. So that's just simply saying that the market's pricing in basically, some kind of recovery going forward. So valuations are pretty full in the sense that at 22 or 23 times the earnings, the market is pricing in good 10, 15% earnings growth. Now, our forecast happens to be around 10%. So, that's why I say valuations are pretty full, but they're not extreme. In terms of when valuations matter, it's really a function of the catalyst rather than valuation by itself being a driver, especially at these kinds of levels, which are way below where we were in the 90s, for example.
So, Binky, do you think that, we've been seeing a little bit more rockiness in stocks broadly as of late, although then they seem to achieve new records every time. Do you think we'll see a more significant pullback in the short term? And if so, would you be a buyer of that pullback?
So what I would argue, first of all, I would point out that, the market's had difficulty since, October, selling off by 2%. Our technical characterization basically of the pullback is 3 to 5%. Those kind of pullbacks are very frequent. We haven't had one for basically 4 months. And the rally has been very, very strong. I would point out that basically, if you look from early November till today, the S&P 500's rising in this very, very tight, very strong trend channel that's going up at a little bit over 4%, so 4.2% at a monthly rate. So, we're now in the 5th month of that. At an annual rate, that's 65%. So it's clearly unsustainable. So we will get a pullback. But I would argue it's still a bit early to get that pullback. I would say closer sort of, I don't think it's 4 to 6 weeks away. I would say, if you look basically, and going back to, your earlier question, basically, over the last few years, both on the way up and the way down, and then in the rebound, basically, mega cap growth in tech's played really, key role. And we think basically that mega cap growth in tech earnings are sort of approaching a crossroads. Whether it happens basically in Q1 earnings or Q2 earnings is open. But if you think about their earnings over the last 20 years, they've been in this basically very, very clear trend channel. Annual rate of increase or rise in their earnings is about 11 to 12%. But they just delivered a 40% year-on-year earnings growth in the fourth quarter. And that's because their earnings, had fallen basically to the bottom of the channel, and we've now moved much closer to the top of the channel. And so, as long as they stay in that channel, and that's our baseline view, then, it does imply a pretty significant slowing in their growth. I'm not talking about bad earnings. So being at the top of your trend channel and moving along is as good as it gets. But it does mean that the comps imply that basically growth rates are going to come down. The market is, of course, very, very long there. It's pretty crowded. And going from last quarter's 40% down to their trend rate of growth, it's a long ways down from 40 down to 11 or 12.
Yes, indeed. Binky, thank you so much for your time. I appreciate it.
It's my pleasure. Thank you.
We're just getting started here on Yahoo Finance Live. Coming up, we're checking in on some of today's top trending tickers, including shares of Dollar Tree sinking as the retailer aims to close 1,000 stores. Plus, the newest edition of our series, Goodbye or Goodbye. We'll get investor insight on 2 stocks to help you make the best choices for your portfolio. Stick around, more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal, to help cut through that noise, to help navigate the best moves to your portfolio. And today we're going to be focusing on the energy sector, specifically infrastructure plays and producers, as global conflicts and OPEC plus cuts drive oil prices higher and expectations we're going to need more energy in this new age of AI. What's the best way to play it? Well, here now with that answer is Rob Thummel, Tortoise Senior Portfolio Manager. Rob, it is always good to see you.
Thanks for having me.
All right, so let's start here, Rob, with your pick, your buy. That's going to be Energy Transfer. Few different reasons for this, Rob, you would lay out. And your first point here, predictable cash flows and dividend. Explain that one.
Yeah, so Energy Transfer is a classic energy infrastructure stock. One of the great things about energy infrastructure, lots of cash flow, lots of free cash flow. In Energy Transfer's case, it's got an 8.5% dividend yield. You can't find a lot of 8.5% dividend yields in any stocks, and Energy Transfer is actually an investment grade rated company. So we really like the stock for investors and think the dividend yield by itself is compelling.
Let's look at another key point here you make. Operates essential infrastructure, Rob. Elaborate on that for us.
Yeah, so operating essential infrastructure, what does that mean? Well, Warren Buffett talks about an economic moat. If you think about infrastructure and how important it is, infrastructure really is the key to anything. It's the key to everything for global economic growth and population growth. You're going to need more energy, and that economic moat that Energy Transfer have is basically its pipeline network. It's it's really irreplaceable. It's more difficult to expand, and you'd have to spend a lot more money to replace the existing pipeline network that Energy Transfer really operates now if you tried to replicate that going forward.
Got third point here. This got my attention, Rob. You would argue to viewers here, this is actually an AI play.
Yeah, well, if you go backwards, if you think, what really drives AI? Well, you need a lot more computing power, you need a lot more electricity, you need reliable electricity, 24 hours a day, 7 days a week. What does that? Well, energy, basically. Oil, natural gas in particular, provides that reliable energy that AI needs. So there's no AI without EI, or energy infrastructure.
Final point here on this one, Rob. You would point out to viewers, this is an investment grade rated debt.
Yep, investment grade rated debt, that once again, with an 8.5% dividend yield, it's an investment grade rated company. There's really a mismatch between the value of the company and its investment grade rating and the fact that it's got an 8.5% dividend yield. Those two just don't make sense together.
Rob, you have made a very convincing case. Before the viewers are listening here, maybe they want to pile in, what is the big risk they need to consider for this name?
Yeah, the biggest risk, Josh, is just a global recession, reducing demand for oil and gas, basically. And we've seen that a couple times, but big picture, Energy Transfer just really charges a fee to move product through its pipelines. That's the predictable fee cash flow story. So if you have a global economic recession, then you're going to have less oil and gas, and that could impact the stock in general.
All right, so here, Energy Transfer is one to buy here, Rob. Let's move over to one you would avoid. That would be Halliburton. A few reasons for that as well. Let's run through them. One, you would point out capital expenditures expected to decline.
Yeah, so Halliburton is an oil field services stock. So it really is subject to what happens in the oil and gas producer space. Oil and gas producers are reducing their capital expenditures, Josh. So that means the Halliburton services are going to be needed less potentially going forward. And so that's one of the reasons why not to buy this stock.
Got it. Also, you would argue, Rob, this is interesting, valuation, in your opinion, not attractive at these levels.
That's right. So Halliburton itself trades at a premium, on an enterprise value to EBITDA basis, relative to ExxonMobil and Chevron. It trades at a higher valuation than Exxon and Chevron. And so from our perspective, we would probably be more interested in Exxon and Chevron, less interested in Halliburton at its current valuation.
Got it. Final point here I want to touch on, lower dividend, free cash flow yield.
Yeah, we just talked about the high dividend yield of Energy Transfer. Halliburton's on the opposite end. They've got a little over a 1% dividend yield, so not really compelling and attractive relative to the broader market. Free cash flow yield, which is really a main attribute of a lot of energy companies. Halliburton's free cash flow yield is significantly lower than other companies that you can really buy and find in the energy sector.
And finally, I'll end here, Rob, just as I did with Energy Transfer. What's the risk to your call with this name?
Yeah, well, the risk here continues to be lower spending, basically, longer term. So Halliburton is really contingent upon, and if we have lower commodity prices, that means lower capital spending, that means lower services and oil field services needed, and then that will have a negative impact on Halliburton itself.
Got it, Rob. Let's wrap this up for viewers. So you're telling investors, listen, buy Energy Transfer, given its high cash flow, essential infrastructure assets, and AI energy demand. On the other side, you're saying avoid Halliburton due to its valuation and poor fundamentals. Thank you, Rob Thummel, for joining us today, and thank you for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.
Time now for call of the day. Tesla. It's a growth company with no growth. That's according to Wells Fargo analyst Colin Langan. He's downgrading the stock today from equal weight to underweight. But on the flip side, Wedbush's Dan Ives, a staunch defender, he says the negative noise on the street is overblown. Let's bring in our senior autos reporter, Pras Subramanian, for more. Colin has been tepid on the stock for quite some time. But tepid is not underweight, right? And so it's pretty dramatic here that he's downgrading the stock.
Yeah, I think that headline sort of says it all. The growth, company with no growth. It's kind of highlighting the concern on Wall Street we've seen recently for Tesla. He's warning in particular that cutting prices to boost sales isn't working, noting that sales were only up 3% in the back half of 2023, whereas prices were cut by 5%. So he's kind of concerned there. Tesla itself warned about their growth prospects, saying that they see significant sort of deceleration there. Most analysts think it'll be around 20% for this year. We'll see, maybe less, but we've seen this story before, right? Where the bears sort of got going here in Tesla, and then they were burned. We'll see if Musk can kind of pull a rabbit out of a hat here. But like long term, I think you mentioned Dan Ives. I think people like Dan Ives, even Adam Jonas at Morgan Stanley, say that this is more of a long term play. Look to 2025, even 2026 for a return of that growth. The question is how long can investors last here when the Mag 7 stocks or the rest of them are kind of taking off, or at least doing better than Tesla?
Yeah. Bloomberg pointed out, by the way, shares of bullish ratings on this name now back to lows we haven't seen since April 2021. So it's pretty impressive, just the sentiment on the name. It wasn't all bad news, though, right, Braz? There was actually some good news for Tesla today out of Berlin, I think.
Right, restarting that production there. I mean, look, it was bad news when it stopped because of that sort of protest and potential vandalism of like a power substation nearby. But good news that they're back to sort of, I think, not sure if they're at full capacity again, but it takes a while to ramp up. But they were making around 4,000 to 6,000 Model Ys a week there, so that's a significant amount of cars.
That feels less like good news and more like the removal of bad news. You know what I mean? Less like a forward, sort of pushing development forward. One other headline that caught our eye today is that market cap-wise, Tesla's now fallen below JP Morgan in terms of its market cap. So to your point about the analyst coverage going down, and to your point about sort of trying to time these things, which is notoriously difficult. But it is interesting that we seem to have reached this nadir of sentiment around Tesla, but maybe it could get worse. I don't know.
Yeah, I mean, look, the stock is still sort of richly valued compared to other automakers, but again, you're betting on that long-term growth. You're betting on that sort of they don't have the legacy costs of a lot of these other automakers to go full EV. But the question now is, we saw Adam Jonas again with a note today talking about how it's bigger companies that are actually kind of dialing back their EV sort of game plan, dialing back their capital spending, being more sort of thoughtful about that spending, and he upgraded the entire sector. So there's this. What are you looking for now? You want more near-term growth or long-term growth? I think that's the bet right now.
That's a good question.
Braz, thank you so much for joining us. Appreciate it. Coming up, financial and bank services accounted for a quarter of AI spending in 2023. Our next guest says those investments are about to start paying off. More on that when market domination returns. Time for some trending tickers as we move closer to the closing bell on Wall Street. Let's check out Dollar Tree here to start. Shares you can see dropping after announcing its plans to close hundreds of Family Dollar stores, as well as some Dollar Tree stores. News coming as the retailer delivers lower than expected fourth quarter results. So, Julie, on the results, earnings did miss the street's forecast of $2.66 a share. Same store sales, they actually climbed about 3%, but and that was better than expected. But the headline getting attention is there's going to be fewer stores here going forward.
Fewer stores, but also in the results, what was interesting is they reported a loss, and it's because of write-downs, partially cost to close those stores, but also writing down the value of Family Dollar, which they, fought to acquire a number of years ago. So it's interesting now that that has not worked out as they planned, and now obviously they are trying to right the ship by closing a number of stores. They also closed a bunch of stores in 2019, about 400 stores. So this is the second time they're trying it, and they're doing it in a bigger fashion by closing more stores.
Well, for more color on this, let's bring in Yahoo Finance's Brooke DePalma, what happened to learn to lead to Dollar Tree now deciding to make these hundreds of store closings. What's the reason here?
Yeah, well, this certainly has been a decade-long struggle of Dollar Tree trying to make Family Dollar really work for them here. And this is the first time that we're really seeing Dollar Tree say, hey, this Family Dollar acquisition actually isn't working, and they're ultimately taking action here. As you noted, Dollar Tree really fought hard for this bid. Dollar General came in with a higher bid. Dollar Tree had the lower bid here, but due to fewer anti-competition concerns among lawmakers, they ultimately led to them closing this deal in July of 2015. And experts telling me that this was a suboptimal business to begin with, that really the signs were against them. It had a weak brand image, it had a weak brand loyalty. They didn't lead the category in terms of pricing, and they also had supply chain issues. And so Dollar Tree tried a number of things. They tried to dabble with private label. They converted some stores. But right now, here we are seeing that the new management who came in a year ago, who actually is the former CEO of Dollar General, the Dollar Tree CEO, he's coming in and really saying, we're going to rationalize these unprofitable locations, turn them around. And experts also telling me they're doing what they can with the cards that they've been dealt.
Yeah, I mean, a couple of things stand out to me, too, about this story. They're closing 1,000 stores, but there are more than 16,000 of these things, which I didn't realize that there are so many. The other thing I didn't quite realize is that Family Dollar more urban, right? And Dollar Tree actually is more suburban and does have a bit of a higher income consumer. The other headline that caught my eye today from the conference call is that Dollar Tree is planning to expand its price range a little bit. They're going to go up to more like the $7 range, which I guess by Dollar Tree standards is a higher price point.
No more $1.25. Now we're up to $7.
Well, I guess they start at $1, but then they go all the way up to $7, which is not as high as they had gone previously. So maybe that is part of the attempt also to capitalize on some of those higher income consumers.
Yeah, and what's interesting too is Family Dollar does have this sort of appeal where people are grocery shopping. They have more than just the general merchandise we might see in a Dollar Tree. People are really going there, particularly low income consumers, for their everyday needs, to cook dinner, to make ends meet. And so it'll be interesting to watch where exactly these customers will go to next. Will they turn to a Dollar General? Will they then turn to a local Dollar Tree store? So after losing these roughly 970 Family Dollar stores, where will these then consumers ultimately turn to buy their everyday needs? We'll want to watch.
Well, maybe they're not turning to McDonald's as much, right? Because we also heard from McDonald's, the CFO speaking at an investor conference today. And interesting here, he is talking about people going to grocery stores rather than making as many visits to a McDonald's, which is interesting as you look at it alongside the sort of Dollar Tree news.
Yeah, of course, we have that CPI report out yesterday, and we continue to see the cost of restaurants not decelerate as much as the cost of groceries. The cost of groceries has come down significantly, or rather the rise in the cost of groceries has decelerated much more so than the cost to dine out. And so consumers are being much more aware of just how much they're spending when they go out, being more frugal about how far they can spend their dollar, whether it be at grocery or dining out. And McDonald's CFO really saying here that they are losing that lower income consumer, not to another chain, but to the grocery store. And I think this will definitely be one to watch, how value and affordability plays into this, how all these fast food giants are really looking to get in front of consumers and say, we have the best bundle, we'll give you the best bang for your buck here.
Yeah, he also talked a little bit about international sales as well. So all of that weighing on the shares today. Thanks, Brooke. Appreciate it. Well, AI has been tipped to be a game changer for most industries, but banking may not be the first that comes to mind. Though financial and bank services comprised a quarter of AI spending in 2023, amounting to around $154 billion. That's according to Wells Fargo, who says we're just about to see that investment start to pay off. Mike Mayo is managing director and head of U.S. large cap bank research at Wells Fargo. He's the one who gave us that number, and he's here with us in studio. Mike, it's great to see you.
Nice to be in this new modern studio.
Thank you so much.
Yes.
Appreciate it. So you put out this large piece of research on this, and I have to admit, I'm one of those who I did not think of banking first off when you think about AI spend. But I'm curious concretely, what kind of changes are customers going to see, and what kind of efficiencies are these banks going to get when it comes to AI?
Well, shameless plug for my hobby of weightlifting. I have a barbell strategy. We have the best in class JP Morgan as my number 2 pick, and the worst in class Citigroup as actually my number 1 pick. Yesterday we hosted a New York City conference, and we had the head of JP Morgan's head of AI basically. And I think JP Morgan could wind up becoming the Nvidia of banking, because they are Goliath. Goliath is winning. They have more data than anybody else. They've been at this for a decade. They've extracted AI from the rest of technology. They're going through all sorts of use cases. Only 1 idea out of 3 makes it from lab to production, and they should see they targeted $1.5 billion of benefits last year, which would be a doubling from every year since 2020. And so they have the resources, the spending, the data, the processes, and the people in place. And I think you guys reported that Jamie Dimon said this will have unbelievable potential. Maybe they'll split it off as a separate business line one day. But JP Morgan has optionality, and they start from a position of strength more than any other bank. So that's your best-in-class example. Mm-hmm. My worst-in-class example, the other side of the barbell, is Citigroup. They've had worst-in-class returns, efficiency. They've fallen short of all sorts of targets. And for there, it's more basic. At my conference yesterday, they invoked Conway's Law, which says that your technology architecture is a function of the architecture of your firm as a whole. So Citi has sold off businesses. Now they've simplified the firm. They'll be done with their org simplification 2 weeks from this Friday. And then that allows for more simple technology to which they can add on AI. So different examples of how 2 firms are approaching it. But for the industry as a whole, it should be able to take banking efficiency toward record levels. So the most obvious use cases are coding. This ancient COBOL code, even I learned back when I was a computer science major, you can transition from COBOL code to C++ or Python in a very precise manner. So AI is very good at doing that. And then all of us are going to have AI co-pilots to make us more productive.
Okay, so just a quick follow for you, and it's a selfish follow, I have to admit. I'm a Citi customer, a longtime Citi customer, and I had occasion to call the bank yesterday with a question. And I got an automated system. And man, did I go down a rabbit hole, so much so that I had to hang up and start over again. It just seems like there's so much low-hanging fruit when it comes to things like customer service. Are they taking advantage of that as they should be once they do that simplification process?
The good thing about Citi is the bad thing is they failed the last 12 restructurings.
Right.
This is restructuring number 13. I think
lucky number 13.
For Citi, everything's upside down, okay? But this one is different for 2 reasons. Number 1, they're selling off businesses equal to 10 to 15% of revenues, so that simplifies them. And they're going from this matrix, multinational, mishmash structure to 5 lines of business: services, banking, markets, consumer, and wealth. And those 5 heads report to the CEO, Jane Fraser. So now, when you ask a question like, how's customer service? Well, how is it in each business line? So services is the number 1 player in global wholesale payments. So that looks good. Credit cards, they're a top 3 player. And you see with the Discover acquisition, that's a value. Banking and markets is a player, and wealth is a player. But they have a lot of work to do, in consumer U.S. banking. That is a whole. The wealth business, that's kind of a hole, but that's 20% of the company. So is the glass 80% full or 20% empty from a strategic standpoint? And you don't have to wait forever, I think. This year, they've given the best guidance for revenues to expenses than any other large bank if they simply meet their targets. I know that's a big ask for Citigroup. If they simply meet their targets, they will probably have some of the best year-over-year performance of any large bank. So sometimes it feels like in recommending Citi as my number one pick, I have hundreds of pounds on my back, and
But you've had some recent experience with that, so it's okay.
So as long as we can lift that weight, and I think they are going to lift that weight, and I think Jane Fraser, come 2-3 years from now, she has a risk of being fired if she doesn't improve the returns, but she also has a chance to become Banker of the Year.
How long, though, do you think, Mike, that restructuring takes just to play out? What's your timeline for it?
I think what's underappreciated, we're talking 2 weeks from this Friday. And you say, well, no bank's ever done this. Procter & Gamble did this. We have an analyst.
Is that the model you would use for this one?
Absolutely. It's like finding a needle in a haystack. I was wondering, our research floor at Wells Fargo, Chris Carey covers consumer staples in Procter & Gamble. And I described to him what Citi is doing. He goes, well, Procter & Gamble sold businesses equal to 10 to 15% of their revenues. Procter & Gamble went from their matrix, they called it a thicket, to 6 lines of business. The similarities are there. So anybody who's ever owned Procter & Gamble for the last 5 years, take a look at Citigroup, because there's a lot of similarities.
I want to circle back to JP Morgan for a minute and the idea that it could be the Nvidia, right, of banking in terms of the AI opportunity. You said they have more data than anybody. How do they use that data to optimize profits, to optimize the business? How is that going to play out?
Well, they have 500 petabytes of data.
I don't even know what that means, right?
It means
it's a lot.
A lot of data. And data is the fuel for AI. And you do have to go ahead and use that data. But JP Morgan is in a position, when they deal with the business, they can use that data potentially to have more insight about the business than the business itself has. They can use that for predictive behavior. So you might be in the market to buy a car. They should be offering you, low-price loans or
They should know I want to buy the car before I know I want to buy the car.
Yeah, look, it's cliche, but it's true. It's become the Amazon of banking, okay? Or TikTok, when what's going to connect you to the next one? What's that recommender? As I had, a speaker from Nvidia at our conference yesterday, and the idea is to have a recommender. The secret sauce, what's going to anticipate what you need, not just based on your prior history, but based on everything that should be known about you on social media and all the clicks that you have and the audio and the video, and you put it all in there, and then you go ahead and in English, in our language, not in Pascal or COBOL or Assembler or C++. In English, you ask a question and get an answer. So this will be a game changer for the industry over the next 5 to 10 years. I'm not changing my earnings models yet for the next year, but I think over the next 3 years, it's in sight. And if a bank does not have a good AI strategy, I would say they don't have a strategy.
All right, here's the other thing. Here's another strategy I need, Mike. Strategy of deadlifting. Because our viewers should know, they know Mike Mayo as a well-known, well-respected financial analyst. I think we have, look at that video. Here's Mike Mayo.
This is squatting.
Yeah, this is what is your one-time squat? Let's see this. Because you actually compete. We should note that.
This was my best. That was 358. But
it's a refrigerator, Mike.
It felt like recommending Citigroup. Oh, you got my squat in there too. Okay. But that squat felt like my recommendation of Citigroup because I'm stuck there, and it's like a 50-year strategy that's failed, and they're getting out of that consumer. 20 years of failed execution. They're combining the systems.
But you dig deep at that point. You go to your heart, right?
You dig deep, and sometimes you feel like that in recommending Citigroup, like, oh no. But you know what? They've come through the last 1 or 2 years. So that was one I've failed many times with my recommendations and in powerlifting. That time I succeeded, and I think Citi's going to follow that path. They're going to grind through and lift that weight.
One-time bench press. What is it?
Not as much as the other. It's 245.
That is solid, Mike. That's impressive.
I have to get that up, but we'll see. I broke the 1,000-pound barrier. That was my goal overall, so I'm looking to improve that.
Impressive.
So, but strength training is underrated, both for individuals and corporations for their resiliency. So there's the parallel.
Bank recommendations, powerlifting, health tips. Mike Mayo, you do it all. Thanks for being here.
Thanks for having me.
Appreciate it. Coming up, we're diving into the recent market momentum in the investor playbook. We'll break down the smartest portfolio plays on the other side of the break. With just over 12 minutes left till the closing bell on Wall Street, we're looking at how to navigate the big picture with the Yahoo Finance playbook. The broader market indices as of late have been largely at the mercy of big tech. Looking at you, Nvidia, we're taking a look at where the market may be broadening and where investors can therefore find opportunities. Joining us now, Katie Kaminsky, Alpha Simplex Chief Research Strategist and Portfolio Manager, and Johan Gran, Allianz Investment Management Vice President and Head of ETFs. Excuse me. Guys, thanks so much for being here. It's great to have you both in the studio with us. Yep. So, Katie, I want to start with you because I think it is a confusing time for some investors, right? Because we've had this monster tech rally. We've had a lot of talk about broadening. But now I think people are kind of confused where they should go, whether they stick with tech, whether they go to those broadening areas.
This is a really good question because I think it's just been such a strong move in the markets, particularly in tech, and it just keeps going. And I think today we're seeing some of that again. So it is hard to go against that trend when the trend just continues to keep being so strong, despite what we're seeing in the other markets out there, like in fixed income.
And Johan, I'll bring you in here too, on that same theme. I mean, clearly momentum has been a big focus for this market, right?
Yeah, it has. I mean, but it's all been gravitating from or pulling from the tech sector, right? But it's been broadening out, like you said, and I think that's the key story. Like, it used to be, you know, call it the Mag 7, you know, lifting all boats, but now it's really all the boats lifting the Mag 7s, if you will. You have a very broad-based rally, call it the last 4 or 5 months. The tech sector is up maybe 30%, but everything else is also up. And that's where you tend to forget sometimes. But this is really broad. A lot of stocks are well beyond their 200-day moving average. So what we're seeing now is very different. It used to be tech, you know, driven by what the expectation is in terms of what the Fed will do with rates or not. Now it's much different. It's much broader now.
And so if that's the case, do you stick with tech, you know, as the picture changes a little bit, or do you go even more broad and just buy the market, Katie? How should people be thinking about it?
Well, I mean, I agree with Johan here, is that you've actually seen that it's also international. So it really has been spreading to a very nice, very long equity trend that has worked very well. And I think that's what makes people a little nervous as well. You're starting to see valuations pretty high. You're starting to wonder, at what point does momentum slow down? And I think if you look at some of the names and the crowding in names, it's definitely something that people are worried about to some degree. What slows down that train?
So what does slow it down, and when does it slow down? Tell us exactly.
I mean, honestly, like 2 months ago, I was thinking it would slow down. I thought it would slow down in February. And here I am in March. This week has been a big mover. We saw a little bit of a pullback, but now we're seeing everything back to everything's business as usual. Things are going well in the equity markets. And I think that continues to surprise me. We're momentum traders, so we're going to continue following that momentum until we see something that kind of changes the narrative.
And Johan, so there's viewers right now, they're listening, they're wondering what do they do with their money. One strategy you talk about are these kind of risk mitigating ETFs. Explain what those are, Johan, and maybe some examples as well.
Yeah, I mean, it's kind of cool because you have a market now that feels a little toppy, a little peaky. You know, there's a little bit of nervousness coming into it, at least at this table. But you also have a lot of investors out there still bullish. You know, there's still this pressure coming up from underneath. The irony is that you have a ton of cash on the sidelines. So people are clearly nervous with how they're voting with their dollars. No question. So the buffer ETFs that you're referring to, structured ETF, defined outcome ETFs, they provide a structure inside of an ETF that gives you upside exposure. So if you buy them today, you can still make money on the upside up to a certain level, like a cap, but you're buffered underneath on the downside. So if the market is down by, you have options here, either 10% or 20%, you don't lose any money over a defined outcome period. So over 6 months or 12 months, for example. So you can partake in the market, but you don't have to go all the way into the market.
Well, and you refer to a lot of cash on the sidelines. I would submit that at least, yes, people might be nervous in keeping money there, but they're also making money, gaining interest in money market funds, for example, for the first time in a long time. So how does something like a money market fund compare to something like you're talking about?
Yeah, sure. So if you think about it this way, if you're in a money market fund, you're getting income that's getting taxed and you still have inflation. So there's not a ton of juice left, even if you get 5% from it. The buffer ETFs that I'm talking about, if you have a 10% buffer, in other words, the market can come down by 10% and you're still made whole, you have an upside cap, the last fund that we had now, about 17%. So you can make 17%, and the opportunity cost is the difference between the 17 and the 5 if the markets continue. Being in a money market when the market's rallying, you have to make a decision to give up that opportunity cost.
How do these kind of buffered ETFs you're talking about, how do they sort of fit into the overall investors' portfolios?
Well, it's a very versatile product, and you don't have time for my whole answer, so I'll keep it short.
Give us the cliff notes.
Cliff note. If you're looking to retire, or if you have retired, and you're starting to think about reallocating your portfolio to be a little bit more conservative, typically you move from equities into bonds or cash, high level speaking. You don't have to. You can still have access to the equity risk premia. You move money from pure equities to buffered equities. You take some risk off the table, but you don't kiss all your equity positions goodbye.
And Katie, to get back to the momentum idea for a moment here, are there pockets where you are seeing a special momentum right now? And what are signs that that is breaking?
This is a good question. I mean, I think we've been so focused on equities that there has actually been some interesting trends out there that we've been watching, particularly in the commodity sector. You've seen a lot of divergence there. You've seen energies up quite a bit today. I don't know if you saw there was some pretty sizable moves, but we've also seen negative positions and short views in the agricultural sector and very disparate, interesting opportunity sets that are going to lead to very different possibilities for thinking about inflation. So we've seen divergence across commodities. We're following things like cocoa. We're following things like corn and also soybeans. Pretty large trends there, which may start telling us where inflation could be going next. If we start seeing that revert, which we have seen a little bit this month, there's some chance that inflation higher could provide some interesting opportunities in the commodity sector. But also short bond positioning is also interesting right now. This idea that cuts are possibly coming later this year rather than sooner. So
interesting stuff.
Interesting stuff.
Yeah. Cocoa, I know, has been a rocket ship.
27% in February.
Yeah, I saw some charts compare. I think our Jared Blickery has a chart comparing it to Nvidia, so that tells you something right there. Katie, thank you so much. Johan, thank you so much. Great to see you both in person. Well, we want to take a look at a couple of movers today, taking a look at fintech specifically. PayPal shares up about 4% today. That's after the company's CFO made some remarks on the company's transaction margin growth and the big lift from its interest income on customer balances last year. He made those comments at a conference today. Excuse me, she made those comments at a conference today. And so, we kind of saw the move in PayPal this morning, Josh, before we saw those comments, but we also noticed that Block was moving higher.
Hit a 52-week high in today's trade.
So, maybe there's just a bit of a bid also more generally under some of these fintech companies.
There was also, you wonder how this plays into it. You saw that headline from Stripe saying volume jumped 25% last year to more than $1 trillion. It was about $800 billion in 2022, just to put that in context. Company said it was robustly cash flow positive. Julian, 2023 expects the same in 2024.
Yeah, although it's interesting, is that a tide that lifts all boats, or is that Stripe's gain at the loss of some of its competitors? I guess we'll have to wait and see till we get some more numbers from all of them. All right, well, we're wrapping up today's market domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. That's the closing bell on Wall Street, and now it's market domination overtime. Josh and I joined by Jared Blickery to get you caught up on the action from today's trade. Let's see where the major averages ended up. First of all, we were just talking on the about the Dow an hour ago, right? And we saw that it had fallen down from its highs of the session, even dipped into the red briefly, but finishing higher by about 39 points. It's just 0.1%. The S&P 500 also just off the lows of the session, down about 1/5 of 1%, and Nasdaq off by about 1/2 of 1%. As we've been talking about, big cap tech has been leading declines. I just wanted to check on the 10-year yield. Remember yesterday in the wake of CPI, we saw it tick up a little bit, didn't seem to affect stocks that negatively. Today, up again 4 basis points to 4.19%. And while we have you, why not check on Bitcoin again? Because yes, it is at or near another record today, above 73,000. Jared's got a look at today's sector action right now. Hey, Jared.
Hey there, Julie. Well, guess what? We got to celebrate a record high here. The first one for materials in just about 2 years. You'd have to go back to January of 2022 to see this sector at a record high. Here is a 5-year chart where you can see finally eking above that. Not a big breakout, but the beginning of one. And a lot of materials companies have been forging record highs this year. And I would throw in the gold miners into that. So a sector to watch for sure. Now, energy takes out the top spot. We have crude oil advancing, utilities, financials also among the winners. But the losers, look at that. XLK, that is the tech sector, that is down the most, over 1% after being the sole outperformer yesterday. And I believe it was a record high yesterday, not today. Also in the red, real estate, healthcare, and consumer discretionary. And then taking the leader, Julie, you just checked Bitcoin. That is the #1 spot in our leaders and sentiment indicators. But tech having a rough day with the chip stocks. The SOX is down about 2.4%. If we take a look at that leaderboard, looks like the lagger board. We have AMD down about 4%. Josh.
Well, Jared, let's take a look today at U.S. Steel, letter X dropping in today's trade, and you can see a big drop. The reason, a report that President Biden does plan to express what's being described here as serious concern over its proposed takeover by Nippon Steel. Apparently, Biden is going to issue this statement, Julie, before the Prime Minister from Japan arrives for a visit on April 10th. This is all per the Financial Times citing sources. Company did say it's going to hold a special meeting in connection with this proposed takeover on April 12th. So a few different moving parts here, but you can see the reaction in today's trade.
Yeah, the United Steelworkers have been very unhappy with this deal, and they have been meeting with Nippon Steel to try and get this over the line. In fact, back on March 7th, there was an in-person meeting between the head of the United Steelworkers as well as the executive vice president of Nippon Steel, and they didn't come to an agreement.
Right.
So this seems to be part of what's going on here, that perhaps the president, who we know has close union ties, is taking that into account. But the stock reaction today was very clear when this story came out.
Well, it's so interesting because it is politics. I mean, Pennsylvania is a critical swing state in this election, and Biden now finds himself in between the union and voters on the one hand, and then Japan on the other. Yeah. He also doesn't want to alienate, obviously, a very critical ally.
Yeah, definitely. All right, let's talk more about the top takeaways from today's trading day. Let's bring in Yahoo Finance's Josh Schaefer. And Josh, the last story, brings to mind the idea that presidential politics sometimes does affect the markets and affects individual companies.
Definitely.
And we're getting closer to the presidential election, so maybe we're going to see more of this.
And this isn't the first time we've seen it even this week, right? Truly think back to Monday, we saw a pretty big drawdown in Meta. Now, I don't know if I would give the full 5% move that we saw at one point on Monday specifically to former President Donald Trump, talking badly about Mark Zuckerberg and Facebook and Meta, but it did correspond with the move, so we were sort of looking at it in that realm. And then you've seen some of the other stocks that former President Trump has talked about repeatedly, or has been linked to, I should say, repeatedly, in DWAC and Rumble. Those stocks have been rallying to start this year, and it's just curious to sort of think about as we get into this election cycle and remember, as these presidents are talking about different pushes and they talk about companies, investors are going to be listening to that trade. And it's just something to be aware of, I think, if you're an investor in certain companies that we know they're going to be talking about. So that was one takeaway I had today, guys. But I want to move on to my second takeaway that's up on the screen right now. Commodities are just ripping.
Like, we've been talking a lot about gold, and I know gold gets a lot of headlines when we see gold at a record high, but it's beyond gold, too.
Yeah, Katie Kaminsky was just talking about this.
Yeah.
Cocoa was one of the ones that
The
she
cocoa
cited.
chart's ridiculous. The cocoa chart is it's flat out ridiculous. I mean, Jared put it up next to Nvidia.
Yes.
And it looks like a similar climb. And it's been interesting. You've seen silver popping. You've seen copper popping. You've seen stocks related to copper. You think of like a Freeport-McMoRan up 5% today. So you're seeing those stocks move as these commodities move. And one thing I wanted to mention, guys.
Do they still call it Dr. Copper, by the way? Is that still a thing?
Dr. Copper?
People still call
the
it
red
Dr.
metal.
Copper.
I like Dr. Copper.
Dr. Copper because it is an economic indicator. So traditionally, that's why it's been called Dr. Copper. Like it's the doctor that tells you what's going to happen economically.
If it keeps going higher, we can do Dr. Pepper and talk Dr. Copper.
Those are good
There you
charts.
go.
Now you're talking.
That's the 4 p.m. market
That's your
wrap
next
coming
story,
up soon,
Schaefer.
right?
Yeah.
One other thing, guys, I wanted to point out with that I've been interested in commodities is just the relationship between silver and gold, and if silver starts outperforming gold. I recently worked on a story on stagflation and the different signs we can see in terms of that. And one thing Michelle Snyder had highlighted to me over at Market Gauge is she said back in the 70s and 80s when we had that big bout of stagflation, one of the key signs was you started to see silver outperforming gold. We're looking at a short-term chart there. This isn't a big trend, but overall, as we're talking about stagflation, it'll be interesting to see if that trend sort of continues.
Well, and I'm just sort of looking at some of these commodities on the Wi-Fi Interactive, and it's interesting because the breakout has been quite recent. So here's silver, for example, year to date, and it just went positive for the year, call it in early March. So this move up has been relatively sudden. That's the same case goes for gold as well. So it's kind of interesting how that's been playing out, that it's all of a sudden kind of roaring from nowhere. There's corn. That one's not doing
Well, it's
quite as
because
well.
everything's roaring, right, Julie?
Is it because everything is
No,
roaring? I'm looking
no.
still for cocoa. There's our cocoa. That one has been roaring. Year to date, up 65%.
It's the Nvidia of commodities.
Right.
Is that what
We've
we
got
call
a lot of Nvidias of things today, right? We got JP Morgan's
We
Nvidia
the
banking
problem is
today.
we went a whole hour without mentioning Nvidia. I think I thought I had to bring it up.
No, we got to
at some point.
overdo it.
Yeah.
Exactly. And what's your last takeaway? Speaking of Nvidia.
Should we do an Nvidia of sectors?
Yeah, let's do it.
We can
What's
just call
the
it that,
Nvidia of
right? We won't
sectors?
call it if something hits a record high, it's the Nvidia of X or Y, right? But it was interesting. Jared just highlighted this. If you take a look at XLB, that hit a record high for the first time in over 2 years today, and adding that sort of to the string of record highs that we've been seeing, right? So when we take a look at the S&P 500 and sort of go under the hood, you're seeing other sectors we're talking about materials specifically right now, hitting a record high, which is interesting to highlight. And then you had financials again hitting a fresh record high again today. They just started hitting their record highs. That's been picking up. So I think you guys were just talking recently about the broadening out. Are we seeing it? Are we not seeing it? One thing a lot of folks highlight is just look at the different sectors. It's not just tech. I was looking at sector year-to-date performance a little bit ago. Tech is not one and it's not two. It's communication services, financials, and then tech.
I mean, communication
services is
techy.
tech.
Yeah,
sure.
I've got this up on the interactive too. If we want to take a look at it, the XLC is the best performer. Here's the year-to-date performance. So the only lagging one is real estate, and it's interesting that interest rate sensitives are in the lagging position, real estate and utilities, but the others are doing great.
Flip it to the 1 month.
Flip it to the 1 month, he says. Okay.
When we go to the 1 month, I think it's just interesting to see sort of the flip we had there, right? So the screen we were looking at before year to date, you had communication services and tech sort of up high, but then when you look at the 1 month now, here's where you really see that rotation,
Materials
right?
and energy.
Materials and energy has kind of been the trade for a month now.
Yeah, and here's tech just kind of in the middle there, right? That is not up as much over the past month.
So maybe it's not all just Nvidia, or maybe it is.
Maybe it's not.
Maybe it is.
All right, thanks, Josh.
Tomorrow's story. Joshua, thank you. We move on here. The House of Representatives passing a controversial bill to give China's ByteDance 6 months to sell TikTok or face a U.S. ban of the app. That bill, which raised issues of national security, easily passed by a wide margin in the House, but it is not a done deal yet, of course. Still faces major hurdles in the Senate. Joining us now is Tobin Marcus, Wolf Research Head of U.S. Policy and Politics. Tobin, it is good to see you. So, Tobin, the House passes this bill by a landslide, but of course now our attention turns to what happens in the Senate. What do you think is going to happen there, Tobin?
Yeah, I think mostly a lot of nothing is going to happen. You know, we're going to see a lot of comments from senators. We're going to see a lot of people saying that they agree that TikTok is a threat, that they want to take a close look at this bill, that they have concerns about the specific approach. But in general, the Senate tends not to feel a lot of pressure just because the House happens to vote on something. Multiple different folks in the Senate, not least of them Maria Cantwell, chair of Senate Commerce Committee, which is one of the committees that will have jurisdiction here, have been working on their own approaches to TikTok for quite a while now. And the fact that the House suddenly leapt into action on this bill over the course of the past week or so, I think is not necessarily going to make them feel like they need to go ahead and do something right away. And, the signals from Senate leadership are they're going to kind of run a normal process where everyone's in the loop and everyone gets time to weigh in on the approach, which means probably that this is going to drag out without clear signals in the Senate longer, past the point that there is an obvious vehicle to attach it to, because we're getting closer and closer to the election and there are sort of not that many bills that are going to get done between now and the end of the year.
So if it doesn't get done now, will it ever get done?
Yeah, I think that the realistic avenue for getting this done is the next annual defense policy bill, the so-called NDAA for FY25, which will get done sometime after the election in the November, December, January timeframe. That's a bill that happens every year, sort of one of the last bona fide bipartisan things that gets done. TikTok has some level of national security angle to it. It's not a defense policy question, but it is somewhat germane. So I think it's a foregone conclusion that we see an attempt to attach this bill to the House version of NDAA. Possible that the Senate goes along with that in putting their version together over the summer. So I think that's sort of the next threat that we're looking at. And even if they miss that boat, I don't think that the noise is going away on this, whether it's this bill or some other bill. Like, the concern is clear.
And Tobin, if this did become law, I'm just interested to get your take. How do you think the CCP, the Chinese Communist Party, would respond, Tobin? Would there be a risk, do you think, they retaliate in China? A lot of American companies do a lot of business over there, right? From Apple to Tesla to Nvidia.
Yeah, so, it's an interesting question. It's come up a lot over the course of the variety of different economic restrictions the U.S. has rolled out on China, not least of them the exports on, or the restrictions on semiconductor capital exports that have been rolled out and tightened over the course of the past couple of years. And generally, we have not seen that much in the way of direct Chinese retaliation. Certainly, sort of directly in the social media and internet advertising domain, it is already the case that the sort of big U.S. internet giants are not kind of allowed to have much penetration into China. I think they have a lot to lose in terms of, really sort of draconian retaliation that is essentially unrelated to what's going on here. If they were to go after Apple, like, there are a lot of jobs and economic activity inside of China that are connected to Apple's manufacturing footprint there. So I think probably we'll see some symbolic actions, but I don't know that it really qualitatively changes the U.S.-China economic relationship or the kind of risks that we face there.
Tobin, I think of one of the other Chinese companies that was affected by U.S. regulation, Huawei. Are there any parallels there? Are there any kind of things we can learn from looking at that situation as an analog to this situation?
Yeah, it's an interesting one. In Huawei, I think that was a use of existing kind of emergency economic authorities to really use the nuclear option, full blocking sanctions there, kind of cutting them off from transactions in the dollar system. I think the track record of attempts to unilaterally go after TikTok from an executive action perspective so far has not been particularly strong. President Trump's efforts were kind of blocked in court. The efforts of the CFIUS under Biden also, I think, have been slow because they expect legal challenges. And I think, unlike in the Huawei case, there is a real consumer concern. Like, I think it matters to the viability of this bill in Congress that it is at least being pitched as an effort to force divestiture rather than a direct ban of the platform. Whether or not it ends up being a ban is a different question, but it depends on decision making in Beijing. I tend to think that it probably does, but I think it's a different conversation for folks in DC to say, hey, we think it's important that if this keeps operating, it needs to be in American hands, versus we're going to just sort of directly nuke this thing from orbit with sanctions.
Tobin, finally, I wanted to ask you about voters and how they feel about TikTok, because we have seen TikTok send out alerts. We've seen people calling their members of Congress over this. Is it going to mobilize voters, though? Is the TikTok issue something that people are going to come out and vote on?
Yeah, so I think up until last week, the hope would have been that the responsibility for any move against TikTok in DC would be pretty broadly diffused. And so, no party, no political player would face a really dramatically greater amount of voter backlash for having taken action on this than anyone else. Trump's sort of sudden, odd reversal on TikTok last week into this week, I think changes that calculus. There's been a lot of conversation about what it means for the kind of political calculations of Republican members of Congress. But from a Democratic perspective, it also means that Trump would be in a position to say, unlike the rest of these, swamp creatures in DC, I was not trying to go after this. I didn't want to take away this thing that 170 million Americans are using and liking and sort of taking away their free speech rights. So, I think the concern about sort of disparate partisan impact of this is probably going to be a concern on Democrats' minds as they sort of go through this process in the Senate. If it were to move forward, I think it would be an issue for some number of voters. Probably most of them would just move over to Reels or some competing product. But certainly there would be elections are decided at the margin, and this is the thing that some number of people care about intensely.
Tobin, thanks so much for joining the show today. Appreciate it.
My pleasure.
Coming up, drivers can expect to pay higher prices at the pump in the coming weeks. We're going to talk the latest crude awakenings on the other side.
And we've been talking about commodities rallying today. Oil and gas have been a part of that rally. And Yahoo Finance's Ines Ferre has the details for you on the latest price action as we see those bump ups. Ines, how you doing?
Yeah, Julie, oil today up more than 2% with WTI closing just below the $80 a barrel level today, and Brent crude closing below or above $84 a barrel. Part of the reason for this has to do with inventories. Those API numbers that came out, those dropped by 5 million barrels for last week, and that's much more than what analysts had been expecting. Across the board, you saw gasoline inventories also down. Now, this comes ahead of the EIA numbers that are coming out tomorrow. Also, geopolitical risks have really driven up these prices. You have drone attacks on Russian refineries that have impacted those refineries. Russian diesel exports are impacted by this, and those customers have to buy those supplies elsewhere in the world, which brings me to my next point, is what's happening with gasoline prices. Those have been going higher, and those are expected to go higher in the coming weeks. Part of this has to do with that summer blend that starts around this time of year. California already started mixing their summer blend of gasoline. That's more expensive. California prices, by the way, are at $4.88. You've got the national average right now that's at $3.40, up about 18 cents from last week. And Gulf Coast refiners, those have started to mix their gasoline blend, their summer blend this week, and that is going to impact prices going forward. You also have some refineries that have been doing maintenance, so that's been impacting prices. And that BP refinery out in Indiana, that is a large refinery that has been trying to come out of the impacts that it's had because of a power outage as of February 1st. So it's been a long time coming, weeks of them just struggling to sort of ramp up their production there as well. And that's been impacting prices. And the reason why it's important is because we saw what the gasoline prices did to inflation last month. Julie?
Inez, I'll take it from here. Thanks so much.
Thank you.
A key theme for markets, it's all about AI, we know that, and it's not just about chip makers and internet names. Macquarie's out with a new note highlighting opportunities amid the hype across a spectrum of software and hardware stocks. And joining us now is Tim Nolan, Macquarie Senior Media Tech Analyst, here to take a closer look at the advertising space. Tim, it is good to have you on the show. Maybe just start, Tim, big picture, because you point out how advertising and marketing companies, Tim, they're already integrating AI and benefiting. How so, Tim? Walk us through some of the examples you're seeing in those two industries.
Sure, thanks. AI is a huge theme, as you mentioned, across so many industries. In the media and advertising space, it's been a factor for many years already. If you think about, media companies that are using AI as part of their image or video generation, ad agencies that are using AI to help create, multiple versions of ad creative content, for example, where you can just sort of throw in, a local reference for a product, for example. I think of much broader implications as well. The search market could change because of AI. ChatGPT brings much broader implications to how consumers can perform searches. Search is a $200 billion industry. It's a quarter of all ad spending. We wonder how that might change as consumers interact with AI applications more in the future.
Hey, Tim, it's Julie here. Does this mean then that there will be a big drop in ad spending frankly, if the searches get better or if they get more targeted, if you don't have to go to as many places?
Mm-hmm. No, that's not how I think of it. I would think the search market itself, what I mean is as ChatGPT and other functions come to search itself, the way that consumers perform searches may begin to change. So there are search-like applications where you can just speak into your phone about any topic of interest. You might want to book a hotel room, or you might wonder what the weather is in Beijing, and you can just get a reply that may or may not be generated delivering advertising alongside with it. But I'm thinking more broadly here as well. Advertisers who have been putting about a quarter of their dollars of their ad spending globally towards search have other ways that they can apply their spending now. So we cover a couple of companies in the ad tech space, for example, AppLovin and The Trade Desk, which are very, very involved in ad transactions, automated ad buying for The Trade Desk across multiple industries, multiple media, for AppLovin, more specifically focused on mobile gaming. And both of these companies, they see huge volumes of transactional data. They can feed that data into their AI engines, and they can then use that to make their automated ad buying platforms more effective. The more effective this proves to be, and AI generates better responses on the ad purchases that they make, the more advertisers may think about, well, should I be advertising as much as I am on search when search is changing? I can put more money to work in other areas, such as these other demand-side driven platforms. So it's not about more or less necessarily. It could be more, because advertisers are looking for returns on spending. The better returns they get, the more they're willing to spend. And with these new types of tools, there are just many, many more ways that advertisers can approach how they market to consumers.
And so, Tim, so you point out some names that you think will poised to benefit from the increased use of AI. So AppLovin, Trade Desk, LiveRamp. Are there names in your coverage universe, Tim, that you think are disadvantaged by the increasing integration of AI, or maybe just positioned here not to benefit as much?
To tell you the truth, we don't call out names under our stock coverage that we think will necessarily lose from this. And the reason for that is I have perhaps the luxury of covering a very interesting set of companies across the advertising value chain. And probably most of these companies actually are incorporating AI into their functions. I mean, ad agencies can benefit from this, the cost efficiencies, the idea generation that AI can bring them. I would say it's more like smaller companies, smaller advertisers, smaller publishers that maybe don't have the sophistication, don't have the ability, the tools, and may fall further behind from the larger companies that are employing these tactics.
And finally, Tim, I'm curious, with the new sort of privacy regulations and opt-out ability for across a broad swath of websites in the U.S., what effect does that have on advertising? Obviously, it's had a big effect on tracking, but does AI help all of these companies sidestep that?
Oh, I'll have to think about that one. There are some very, very big changes happening with the deprecation of cookies on the Chrome browser. Mobile ad market players are enacting changes as well that will affect the ability to access data signals that give advertisers the tools that they need. I don't know if I can answer your question directly, but I would say AI does give ad tech companies, advertisers, ad agencies, abilities to do things in a different way than they've been accustomed to. So the loss of signal, the ability of consumers to opt out of tracking, to opt out of cookies that are understanding what they're doing. AI can provide other tools for advertisers and ad tech companies to approach consumers.
Tim, thanks so much for joining us today. Appreciate the time and insight. Time now for To Watch tomorrow, Thursday, March 14th, another key day of economic data on tap, including producer price index, retail sales, initial jobless claims, with the CPI coming in hotter than expected Tuesday. February's PPI data may further validate the notion that inflation is not slowing as quickly as the street and the Fed might have hoped. Wholesale prices climbed 0.3% in the first month of the year, which was the largest jump since August 2023, and the street is expecting to see the same number cross the tape Thursday morning.
We'll also be getting a fresh update on retail sales. In January, they posted their steepest decline since March of 2023, but the street doesn't expect that trend continued in February. Economists predict the retail sales grew 0.8% month over month in February. That's a rebound from the 0.8% decline seen in the first month of the year.
And on the earnings front, we'll hear the latest from Dollar General, Dick's, Adobe, and Ulta Beauty. Dollar General under pressure Wednesday following some weak earnings from Dollar Tree, who plans to close about 1,000 outlets over the next few years. Dollar General is expected a revenue of $9.78 billion and an adjusted EPS of $1.73.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Stay tuned. We've got more Yahoo Finance on the other side.
Liquid Death, one of the fastest growing names in non-alcoholic brands, has closed more than $60 million in funding, putting its valuation more than $1 billion. The company made a splash on the beverage scene just a few years ago with its canned water that promised to murder your thirst. Liquid Death has since expanded to sparkling water and iced tea offerings, and a new lineup of big name investors could bring new opportunities in the year ahead. I'm joined now by Liquid Death's founder and CEO, Mike Cesario, and of course, Yahoo Finance's very own Brooke DePalma. Mike, it is good to have you on the show. So you closed $67 million in financing, Mike. What do you plan to do with that money? How are you going to put it to work to now build and grow this business?
Yeah, like you guys mentioned, we started off as just mountain spring water in a can. And, eventually launched sparkling, and then we launched flavored sparkling, which actually has, a few grams of sugar from agave. So it's kind of more like a healthy soda. And then we launched Liquid Death iced tea last year, which has been really successful. So, we've really kind of proven that we're building a true cross-category healthy beverage brand. And, now that we've sort of dipped our toe in some of these categories where, with flavored sparkling, we started with just 3 flavors. Iced tea, we started with 3 flavors, and now we're starting to really add more innovation and flavors into these categories that are starting to work.
Hi, Mike. It's Brooke here. Live Nation is a longtime investor in the company. They played in this recent round. How has this partnership helped the growth story of Liquid Death?
Yeah, I think a big part of what our brand is, all the fun marketing for most food and beverage brands are for unhealthy things. Anything that's funny or exciting, it typically is for, candy, junk food, fast food, beer. So we're trying to make a healthy brand that markets in the same funny and fun way as, unhealthy brands. And we're even starting to source occasions from the beer side of things, because this is more of a replacement for beer or a soda in a lot of people's routines. And whether that is being at a music festival or a bar or a venue where you don't typically want to walk around with a glass of water, Liquid Death kind of creates a new experience to drink something healthy, but it's actually fun to walk around with.
And some of your investors here, Mike, it is an eclectic, impressive group. So I'm seeing DeAndre Hopkins, got the comedian Jim Jeffries, fantastic. Josh Brolin, we all loved him in Sicario, I know. I'm interested, Mike, how do you actually decide which investors get to invest? Do you meet like a Josh Brolin and decide, listen, he just gets this company where we are and where we're headed?
Yeah, you're pretty spot on there. We've had the luxury of, being able to be selective about the investors that we bring into the company. And we really, are focused on people who truly love the brand, understand what we're doing. And all these folks, they come sort of inbound to us where we find, hey, they're a huge fan of the brand. And then if there's an opportunity to invest, we can find a way to sort of get them in.
Mike, TikTok has played such a large role in the growth story of Liquid Death. Of course, there's a potential ban happening here in the U.S. What sort of impact would this ban of TikTok here in the U.S. have on the company?
Well, we like to say at Liquid Death that the way we think about marketing is we are day traders of attention. We try to find where's people's attention at, what is the most cost-efficient way to go get that attention. There's TV commercials, you can reach a lot of people, but what you're paying per eyeball is really high to get your message to them. Whereas social platforms and emerging platforms, there's a lot of attention there. The per eyeball cost is a lot lower. So TikTok just happened to be a place where there's a lot of attention. And when we have our entertainment comedy first approach to marketing, we're not here to make ads. We're here to make actual entertainment that makes people laugh. We can go into any platform where people's attention is and they're into what we're doing. They want to follow us because we're providing value. So even if TikTok goes away, whatever the next platform is where people shift their attention, we'll go there and gain followers by continuing to entertain people.
And Mike, your company now, it's valued here at more than $1 billion. What about going public, Mike? Is an IPO a possibility? And if so, what are sort of the factors, the variables that depends on?
Yeah, we're really just focused on building a large, profitable business. And we know that if we kind of stay on that course, that we will have optionality for any outcome that we want, whether that is an IPO or whether that's a strategic partnership. So we're of course going to do everything that we have to do to preserve optionality. And if an IPO sometime in the future is something we want to do, we've got to go through all the steps to make sure that that's even an option. So that's really how we think about it.
Mike, grocery prices have been steadily increasing over the past few years. Some may say that this is overpriced for water. What do you say to that?
I mean, we're right at the same price point as most other premium waters in our just plain water SKU. So Fiji, Essentia, Pellegrino, all of that. We're right around the same price as all of those brands when it comes to premium water. And then, in flavored sparkling and healthy soda, we're not actually priced that much more above where other premium brands in our respective categories lie.
Mike, thanks so much for joining the show today. Appreciate it. And of course, our thanks to our very own Brooke DePalma as well.
Thank you, guys.
And coming up, how the recent spike in immigration may be benefiting the labor market. More on that when Yahoo Finance returns.
Breaking news, Kevin Blank is coming back to Under Armour as its CEO, replacing Stephanie Linnartz as head of the company. The company also announcing that Mohamed El-Arian, who has been on the board of directors for the last several years, will become chairman of the board. Now, this is a surprise. Stephanie Linnartz had only been in that role since February of last year, so call it 13 months. that she held that position here with Kevin now coming back to take the helm of that company. And I know you've been looking into sort of how the stock has been doing. Obviously, right now it's going higher, but it's been kind of a rocky road for Under Armour.
Yeah, I mean, if you look at the stocks, really, it's done a whole bunch of nothing year to date and over the past 12 months. You can see at least the initial reaction here in the after hours is interesting with a pop. Of course, Plank, founded this company in 1996. Just looking through the release, he goes on to kind of talk about his tenure there, how he says the opportunities ahead, what he's willing to capitalize. Says for nearly 30 years, the company's been focused on inspiring athletes. Talks about industry-leading performance solutions, and says he looks forward to seizing the opportunities ahead. Investors have not been excited about this name. If you look at the street and how they feel about it, even after that underperformance, most are on the sidelines, about 60% still with a hold, even after that kind of underperformance. But maybe this changes things with Plank coming back on board.
Yeah, I mean, again, it's just sort of shocking. I mean, Stephanie had been at Marriott International for many years before she was hired away to run Under Armour. So it'll be interesting to see if she has a next chapter in corporate America as well. But Kevin Plank, it'll be very fascinating to see what changes he puts in place, if any, to sort of try to reinvigorate Under Armour, which has been in the works for a few years now.
Stock up about 6% right now in the after hours. Surprising strength in the economy since the pandemic, maybe down to a spike in immigration, according to new research from CBO. The study draws a correlation between high numbers of people entering the country and the better than expected labor market data, along loosening inflationary pressures. Rick Newman has been looking into it all. Rick.
Well, there's a lot of research going on here. I mean, economists generally tell you that immigration, legal immigration, is a good thing. We need immigration and we need population growth to make the economy grow and to make the labor force grow. And by the way, we need more young workers to pay the benefits for Social Security and Medicare recipients. So here's a couple of things we know. We know there's been this surge of migration at the southwest border during the last couple of years. People may be confused about this, but most of those people are not so-called illegal or undocumented immigrants. Most of those people who come in through the system, they get assigned a hearing date, or at least they go into the system, but this hearing date doesn't come for 5 or 10 years. And so they're allowed to work. They can get a work permit while they're here. So we've seen this surge of people into the United States who are getting work permits and working legally. And at the same time, how many times have we been sitting here talking about, well, the unemployment report surprised to the upside yet again, it beat economists' forecasts. Well, there's new research now from the Hamilton Project at the Brookings Institution that puts these two things together and says there does seem to be a definite correlation between more migrants coming in, an increase in the labor force, an increase in the number of Americans working, and even a slight increase in GDP. In other words, this is good for the U.S. economy. Now, that's not the coverage it's getting. The coverage it's getting, of course, is that this is a so-called crisis. Some cities and certainly parts of the border are overwhelmed with migrants who don't know where to go. We don't have enough resources for handling.
Well, even here, Rick, here, the mayor of this city has called it a crisis.
Also, Chicago, Los Angeles, San Francisco. It's hit the sanctuary cities, the Democratic-controlled cities who have been begging Biden to do something. But it's almost like there might be like a hidden benefit here to the economy. And look, Biden has clearly benefited from an economy. The recession that economists have been forecasting keeps not happening. Growth keeps up being higher than forecast. Employment ends up being higher than forecast. So one of the reasons these researchers are saying is this flood of migrants into the country, most of whom are ending up in the labor force and working.
Rick, there's a lot more I want to ask you, but we're out of time. So I'll have to do it off camera in the newsroom. Thanks so much.
We'll have to discuss this another time. I wonder if we'll be able to do that.
I'm sure it won't go away. Thanks a lot.
Bye, guys.
Rick. Well, Nvidia is on a tear so far this year, surging nearly 80% thus far in 2024. Bank of America seeing shares will head even higher. Of course, there's a world beyond Nvidia for those looking to get into the AI arena, some of them looking to get in very early. Joining us now, Martina Lochenko, Costanoia Ventures partner. Thanks for being here, Martina. So you are at the very early stage of some of these next waves of AI. You guys are at the sort of seed stage in venture capital. So where, not just specifically, but also sector-wise, where are sort of the next innovations going to come from when it comes to AI?
Yeah, well, Julie, you ask a really great question, which is if you're not Nvidia, which is doing the compute, what do you look for that is enabling this same Gen AI era? And for us, that is really all about data infrastructure, because someone has to write all the models. You need the data coming in and being stored and having the pipelines and having the data scientists that can build the models that are doing all of this work. All of that is in the category of data infrastructure. And so we see that as being one of the biggest, most important areas to continue to invest in. There's also applied AI, which is in specific verticals like defense, where you can take in all of this raw data and intelligence data and then do the job of an analyst, or cybersecurity, where the bad guys are doing a lot of bad stuff with this Gen AI, and we need an equally strong cohort on the cybersecurity side, fighting for the good guys.
Martina, I'm interested in your role. You're talking to a lot of young, smart entrepreneurs focused on AI, and you've got to decide, who you write a check to and who you don't. How are you making those distinguishing between these, Martina? How do you distinguish between, what's real, what looks meaningful, and what looks like marketing fluff?
Well, for sure, the team is the most important thing, and you have to assess that through references. But the bar has just become higher. There was $11.5 billion invested into the seed stage last year, but that's down from its peak just a couple of years ago. And so we always want to make sure, is this a team that knows how to learn and adapt quickly? We joke there's a founder in our portfolio that says, everything that I know will be obsolete in 5 years. And that could be true technically. And so we have to have people that know how to adapt to how quickly things are changing on the technology front, as well as be able to respond to market segments and how dynamic they are. And that comes up in how they behave and what their references say about what they've done in the past.
If things are changing, though, that quickly, I mean, won't we see some of these companies maybe change entirely what they're doing in that period of time?
That is absolutely going to happen. That's a really normal thing for early stage investing, is we can't be married to the idea, which is why the team becomes so important. Are they reacting dynamically to what they've built and how it might need to adapt to what market or technology reality when they are finding that traction point? So early stage investing is really about being able to roll with all of that as it evolves.
Martina, can you give us maybe an example of an AI-focused startup in your portfolio, one that you're excited about?
Yeah, well, Vannevar Labs is a great example of that applied AI that I was talking about. So they are ingesting all of this raw image data, audio data, and being able to process it in a way that essentially does the job of an analyst. And so the Defense Department can be much more specific and fast in how they're allocating resources. Or a company like Delphina, which is helping the data scientists who are building all of these models that are creating this era of Gen AI build better models faster. So this is going to yield more intelligent sales forecasts, better fraud models, more dynamic bets on how you were able to do your ad buys. And all of this is powered by Gen AI. And so you need the people who are actually doing the work to be able to build these better models faster. So that's what this tool set and this data infrastructure of the supply AI is giving us.
Martina, thanks so much for joining us today. Appreciate your time.
Oh, thank you guys so much for having me.
Coming up, Under Armour announcing a leadership transition. Kevin Plank is set to return as CEO. Going to break down what this means for the company moving forward when Yahoo Finance returns.
Breaking news, Kevin Plank returning to Under Armour as its CEO, replacing Stephanie Linnartz, who just rounded a year in her tenure as head of the company. The company also announcing that Mohammed El-Arian of Allianz and of Queen's College at Cambridge will be chairman of the board. He has been on the board for the past couple of years. Brian Sazi, our executive editor, covers this company very closely. And so he's here to give us perspective.
My outfit and how I look right now, I think, explains the shocking nature of this, because I was getting ready to leave. And I think this was, and I want to be careful what I'm saying, because this story is still developing. I'm still going through a LinkedIn post that Kevin Plank put out there. Kevin noting he has reflected on his journey at UA. He said he's learned a lot, of course, as a company that dealt with various issues on how it treated employees and various other operational things when Kevin was CEO. So he said he's learned a lot. He calls it a period of self-reflection and learning that has been invaluable. Now, I should note that Under Armour did not want to make Kevin available for an interview, didn't really want to comment much beyond what Kevin posted on LinkedIn. They did remind me that Kevin owns 65% of this company, and that has been always the view on Under Armour. This is a Kevin Plank controlled company, and if he wanted to come back and if he wanted to run the company at any point, he in fact could. Now, I will also add this. Stephanie Linnartz, only about a year mark into Under Armour. She was laying the groundwork to bring Under Armour into the next generation.
What is that? What do you mean? What levers?
The next levers are more focused product, cooler level product, better operational playbook, fewer expenses, a more focused company that is taking the fight back to Lululemon. Now, Stephanie was laying the right groundwork. In fact, I recently talked to her a couple weeks ago for our new series, Lead This Way, and she actually talked about working with Kevin Plank. He's saying that he was very passionate, and they actually had an office right next to each other. But overall, this is a shocking development for a company that appeared to be going back in the right direction. I do find it interesting that Under Armour found it important to remind me that Kevin did own 65% of the company. Yeah. Did the company get an offer to be taken out? Unclear to me. It's also unclear to me what Kevin is going to do differently than what Stephanie was doing. The company was struggling under Kevin. I have much appreciation for what Kevin launched and brought to the apparel market in Under Armour. But those last 5 years of his tenure, this is a company that lost considerable market share to Lululemon, Nike, and many other retailers. Outside of all the other issues it dealt with.
I'm looking at a max chart of this stock. And, as a Baltimore native,
yes,
who I think my dad got in close to the IPO. My father went to Maryland, just like Kevin Plank. This was like the pride of Baltimore when this thing started, right? The pride of Maryland. And I'm looking at the max chart. It went public, $13 a share. It's trading around $8 right now. Peaked just above 50 back in 2015. And maybe she was getting it back on the right track, but the stock has not really reflected that. It's been going sideways. And it's just, I mean, it's a bit of a shame, as looking at what it meant to the, at least as a Marylander.
And to that, it was interesting, Sazi, as soon as that headline crossed, the initial reaction after hours was a pop.
Yeah.
If you're an Under Armour shareholder today, and I will say this is not a one-day story. This is something I think that is going to play out over the next few days. You have to be wondering what caused this separation. Did the company get an offer? Or did they underperform in this most recent quarter? Are people or other retailers not buying what Under Armour is selling for the next 6 months or the holiday shopping season?
Do we know, though, that it wasn't a personality clash?
I asked Under Armour's team if there was a disagreement between the two. They declined to comment to me on that, referred back to me to that LinkedIn post that Kevin posted regarding him coming back. But this is a shocking development, and it's shocking because Stephanie Linnartz, who I originally got to know at Marriott, she really led that Bonvoy program amongst many initiatives, one of the most highly regarded leaders in corporate America. What she did at Marriott was absolutely tremendous, and she was starting to do tremendous stuff at Under Armour, so it's sad that she's being shown the exit.
Saz, thank you so much for your perspective.
Yeah, of course,
on this.
I appreciate it.
I thought of you immediately. I knew you were the guy. Appreciate it.
Thanks.
All right, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a good night.